All right. Meantime, while stocks ended the month on a down note, our next guest says the markets and Fed are overly sanguine on growth and overly pessimistic on inflation. Jack Janasiewicz of Natixis Investment Managers joins us now on the Fast Line. JJ, great to have you with us. A week ago, we didn't have all this cascade of tariffs coming down the pike on Saturday. We didn't have the DeepSeek scare. Does your view of the market change?
You know, I think you still have to look at the underlying dynamics here, and the fundamentals of the U.S. economy are still very strong. You know, and we're looking at nominal growth coming in probably closer to 4% for the full year, slowing from 5%, and that's still above trend levels. And so when you think about that backdrop, that's still pretty good for, I think, corporate earnings here, and that's still what it all comes down to. So look past a little bit of this geopolitical noise, and really the underlying story here is the foundational economic backdrop for the U.S. economy is still pretty robust.
I completely get that you can say it's noise. I mean, the ExxonMobil CEO on the conference call actually said, you know, tariffs are just speculation that it's been driven higher by the media. So there's that point of view. But corporate earnings, in some respects, I mean, it's backward looking. And granted, the guidance is forward looking. But right now, the snapshots that we're getting is the reflection of an economy that is a capsule in time that is no longer the economy we now have with tariffs in place. How do you interpret the impact of tariffs, even if it is in the next 3 to 6 months? Because the next 3 to 6 months impacts the guide that companies are giving now, as well as the guide for the rest of the year.
And that's going to be a wild card, I think, going forward, right? Because, you know, we've heard starts and fits, right? On day one, we were supposed to get tariffs. We didn't. Then we were going to see Colombia being tariffed. Well, they backed down on that one. You know, then it was, well, March 1st. Now it's February 1st. So, you know, a lot of this is still a lot of headline news coming out. So it's really difficult, I think, to really adjust portfolios here because the bottom line, tariffs are still probably going to be a negotiation tool. You're going to start high, ratchet it back down until you get something. But that number, if we end up having to implement tariffs, probably going to be something much lower and maybe less impactful. So I hate to say it, but you almost have to be reactionary with some of this stuff rather than proactive.
And Jack, this is Courtney here. Thanks for coming. I'm curious about your outlook on inflation, right? So you actually mentioned here that people are overly pessimistic with inflation. And I'm curious here, if inflation kind of stays where it's at, we have this higher for longer rates, they're not necessarily going up and not coming down from here. Do you see that as problematic, or can the economy continue to do well with where rates and inflation currently are?
You know, I think we're in an okay spot. You know, I certainly would like to see rates continuing to come down, something, you know, closer to the low fours or the higher threes with the 10-year. But, you know, when I take a step back and look at the inflation backdrop, you know, I think the big picture level says it all, right? And we're seeing the labor market slow. As a result, you should expect to see wage growth continuing to come down. And then, you know, from that perspective, where do you get the demand pull from? And then you start looking at what's going on with regard to housing. You know, you look at all the real-time indicators, so that continues to come down. So between those two things, I certainly have a hard time seeing inflation reaccelerating. Maybe it comes down slower than expected, but I think it still heads lower. And that, I think, you know, basically plays to the idea that maybe we should be expecting more cuts than hikes in here over the rest of 2025.